Let's go.
Good morning, everybody. We are Cherrystone Incorporated, and we're excited to be here at Apple Rock Capital's year-end fund strategy meeting. My name is Adnan Solanki, and I'm here with my colleagues Derek Yin, Rohit Karche, and Chloe Jiang, and we're really excited to share with you our proposal of the fund moving forward. We are an open-ended core plus real estate fund with a diversified investment portfolio. Currently, we are experiencing liquidity issues due to volatile market conditions. In the long term, we have to reallocate our assets to also we also have to reallocate our assets to meet the fund objectives. We're going to be utilizing a top-down approach where we go from macroeconomic conditions, go down to the fund and the portfolio, and then lastly, analyze the asset classes and the assets themselves. We are going to be forecasting where we want to be in Q4 2024 and outline the steps we need to take in order to achieve it. We are recommending to sell the office and the industrial portfolio and doing a residential swap where we sell our existing luxury condominium buildings and buying into the equity opportunity in the Northeast. We are also going to be paying down our line of credit. Now, to talk more about market outlook, I give it to Derek.
Thank you, Adnan. Before we dive deeper into the strategy, let's look at the macroeconomic trends that could potentially influence our approach. The time is Q3. Housing costs is one of the biggest contributors to inflation, and uncertainty is definitely in the air. Interest rate may go up, further distress may come across in the market. Next, the presence of an invert yield curve further signals and highlights the fact that economic conditions has drastically changed fundamentally. To summarize, we have to rebalance our portfolio, reposition ourselves. And why? Number one, there is the uncertainty associated with interest rates is creating pessimistic valuations. Number two, tight lending is creating distress in the market. And finally, lower transaction along with fear of liquidity is going to increase redemption all across. And let's look at the fund. The fund is an open-end core plus fund with targeted levered returns from 7 to 9%. And currently, the fund has a gross asset value of $4.8 billion and a net asset value of $2.6 billion. And currently, the fund is allocated with investments all across the asset class. And specifically, the fund has a greater exposure in industrial properties and residential properties. And currently, the fund has a LTV of 46.4% and has a maximum LTV of 55%. And finally, the fund is benchmarked against the open-end real estate core index. And the objective of the fund is to, 1, reposition itself, 2, outperform the index, and 3, generate steady income for investors over both the short term and the long term. And now I pass it back to Adnan.
Thank you, Derek. Now, let's get on to some of the issues the fund is facing. First, our analysts suggest that GAV is going to fall between 5 and 15% over the next 2 quarters. Now, we've been very conservative with our approach and have assumed that asset values are going to drop 15% across asset classes. This is so that we can prepare us for the worst case scenario. Second, we have a $121 million interest-only loan maturing in Q1 2024. Third, our redemptions are currently high at 4.5%. And fourth, we have to optimize our allocation to outperform the open-end real estate core index fund. First, let's talk about liquidity. Our current cash flows from operations are going directly into distributions to investors. We cannot finance our redemptions and our refinance from these cash flows, so we have to come up with something else. Redemptions are currently high at 4.5%. This is because investors are looking to reallocate their portfolio into public markets as they see a mismatch between our values and transaction values. Now, they've also indicated that they will rescind these redemptions once asset values are aligned. Now, the fund also mandates that we have to fulfill 2.5% of it. Anything above it is going to be at our discretion. To be very conservative, we have also assumed that investors are continuously going to be cautious, and that's why we have redemptions of 2.5% every other quarter. Second, we have $121 million of refinancing due. This is because tighter lending conditions due to lenders pulling back their lending activities and changing the debt criteria is causing a $40 million shortfall in our $40 million shortfall that we have to infuse. Overall, through 2024, we have to inject $202 million into our fund. Now, falling GAV values is going to cause our LTV to rise. We are projecting that in Q2 2024, our LTVs are going to go till 54%, very close to our fund maximum of 55%. Now, because of this high interest rate environment, a higher LTV is going to cause a drag on our returns. That's why we have to come up with a strategy to address it. And last, the fund has to reevaluate its portfolio to outperform the ORCI index that it's benchmarked against. We want to be over-allocated on markets that have a positive outlook and under-allocated in markets that have a negative outlook. Furthermore, we have to explore the optimum balance between minimizing liquidity risk and maximizing investor returns. We have to note that we have to be incredibly cautious at this time and not overreact. Further, to talk more about market sectors is Derek.
Thank you, Adnan. Let's talk about the sector of the 6 disposition opportunities. To really understand how each sector would perform, we looked really closely at each sector. First, we looked at office. We believe that office, due to reduced demand from different companies overall, we believe office is going to continue to decline in valuation and demand. Secondly, we looked at industrial. We believe industrial currently has a low vacancy, and this low vacancy is going to continue on into the future. And thirdly, we looked at residential. We believe for residential, vacancy rate is going to continue to increase, and specifically on premium properties, because households are economizing. And third, for retail, we believe that demand is always outpacing supply, so that there's a more of a positive outlook for retail, and that specifically is neighborhood centers and community centers, where they're with good location and high density locations. And thirdly, we look at storage. Storage traditionally is correlated with the economic cycle, but due to a lower supply in this situation, we believe that storage has a more positive outlook. And finally, data centers, we believe, due to the fact that it has a higher barrier to entry, we believe it has a great growth potential. And because of that, we are overweight in data center, and we are confident about where they're going. And now I'm going to pass it over to Rohit.
Thank you, Derek. Is this okay? Great. So to understand alignment of these 6 assets with our fund strategy and to study their ability to deleverage the fund as a whole, we performed SWOT analysis on each of these assets. Starting with office, the $300 million asset that we have is at 60% loan to value on its value, but looking at the broker's opinion of value, we're at 75%. That's very high. A single tenant occupies the 2 office buildings, and even though the lease is valid until 2035, we feel concerned that one tenant occupies 2 buildings. To reduce the leverage in our portfolio, this seemed like a strong candidate for disposition. We also saw that with the 4% fixed assumable loan, this is a very marketable asset, and that's why we advise taking it to market. Our industrial asset is fetching rents 35% below market and has only 2.5 years left on its lease. We believe that this asset aligns very strongly with the value-add fund strategy, and taking this to market will allow us to get a good valuation and good liquidity on this asset. While we continue to be positive on residential, the current asset has its accretive financing expiring in May 2024. The asset is also in a market where 15% of the stock is under construction. With that, we do want to remain allocated to residential assets, but this is not the asset for us. We're recommending a swap on this asset. Moving on to retail, yes, retail outlook is not undeniably stable, but the asset that we currently have has a grocer anchor tenant, and discount retailers in our asset provide a good hedge against inflation. For that reason, we'd like to stay invested in our retail. Our storage asset is a 100% equity deal. There is no leverage, and because of this low leverage, we'd like to continue on with it. More importantly, the asset can be divided into 3 smaller assets and taken to market because the smaller assets are moving fast, we feel confident in our ability to generate liquidity in the future if the need arises. Our data center asset is a strong core plus asset in a market with a lot of growth potential. This asset promises good core plus returns, is decently leveraged, and has 5.5 years of weighted average lease term. For that reason, we'd like to stay invested in this asset as well. Now, yes, we do want to have comfortable liquidity positions for our exiting investors, but our primary fiduciary lies to our continuing investors. When we're selling our assets at discounted valuations, we should know that we have acquisition opportunities in the market at discounted valuations as well. And to generate returns for our investors, we'd like to look at them seriously. We saw two investment opportunities. The first being a credit investment opportunity as a mezzanine lender for $39 million under a senior loan of $116 million. We were provided debt yield numbers using which we back calculated the NOI to be about $11 million. But looking at the debt service on the senior, we saw about $8 million in debt service, leaving about $3 million to service our mezz debt. We are a core plus fund, and our investors require steady returns today. We're not IRR driven as such. Looking at the cash flows, we saw that even if this loan is structured as an interest-only loan, there is just not enough NOI. The probability of default on this mezzanine loan is very high. We saw that the senior was priced at about 200 bips over SOFR, and assuming our loan would be priced at least 350 bips over SOFR, we saw sensitivities about 9% up to 12% for the mezz, and we see that there's just not enough debt service coverage in this opportunity, and that's why we are recommending passing on the credit investment. On the second equity investment in a mid-rise 125-unit apartment building, a $20 million equity investment with 60% loan allows us to get 13.7% returns levered. And even in the worst case, we are getting about 9.5% returns. This deal is in the Northeast submarket with only 3% of the stock under construction, and we feel confident about rent growth in this asset. Yes, there is an asset across the street coming up, but that's a completely different target audience, and we feel very confident about being able to achieve steady returns in this asset. Sensitizing over cap rates, exit cap rates, and interest rates, we saw that we would need cap rate expansion of over 7% and a rise in interest rates of another 150 bips before we start losing money on this investment. This investment aligned with our core plus strategy, and that's why we're recommending a buy on this equity investment opportunity. With that, I'd like to pass it on to Chloe to talk about the fund strategy.
Okay. Thank you for walking through all the opportunities that we have. So now let's dive into the fund strategy and how our decision-making process revolves around our fund objective. So to restate the issue, we're currently facing a cumulative of over 200 million liquidity needs by the end of quarter next year. This is the short-term issue that we must address right now. As a fund manager, we have fiduciary responsibility for our remaining investor that not just need to address the short-term issue, we need to have a long-term vision to create a sustainable growth within our fund. To do that, we can rebalance our portfolio and chase after the right opportunity. So my colleagues talked about the market level and talk about the property attributes in why we're selecting specific opportunity. And now I want to tie it back to the fund level. So for the first, for the office space, currently we are over allocating. It's highly levered. So by selling one of our assets out, we'll be able to scale down the LTV. Second, for the industrial space, currently, based on our market study, we do see a good outlook. Investor appetite still remain very strong. But when we look at the specific opportunity itself, we realize that the business plan behind the coastal properties does not align with our fund strategy, and that's really the major reason why we want to dispose it. The third one is the residential sector. We remain very positive outlook in here, and that's really why we want to swap this deal with a new acquisition opportunity to mitigate the potential refinancing risk in the next 2 quarters. Storage center, mentioned by Rohit, this is 100% equity. We want to keep it in our fund to maintain our weighted leverage level. Data center, it has a great outlook, and the replacement cost for building a brand new data center or even acquiring one is extremely expensive, so we want to hold it for a long run. We can potentially pay down the line of credit to stop that 7.9% interest payment, and also by doing that, we can further deleverage our fund, and this also increases our firepower to chase after opportunity that may arise in the future. So let's look at the net asset value pre and post allocation comparison. We can see that the redemption has a huge impact in the overall value. It's lower by like 11% at the end of 2024. And in the next 2 quarters, we are also expecting a 15% drop in portfolio value. So in our analysis, we assume the worst case scenario. And under this scenario, we're able to maintain our funds to stay within the 55% LTV. And if we look across quarter basis, we can see that after executing this strategy, we're able to keep every quarter LTV level within 55%. And by the end of next year, we are able to lower it by 1% comparing to pre-allocation scenario. So this is just a sample of how are we going to manage the cash. So to conclude everything, the strategy that we're proposing is to sell 3 assets and also by paying down line of credit. This is a sample of how are we going to execute strategy. We are going to sell all assets in the end of this year, and based on next year, next quarter, what the outlook looks like, we can choose whether to pay down the line of credit or use it to chase after any potential opportunity. So now let me pass it back to Rohit to do the final closing for us.
All right, so with all the reallocation strategies that we've mentioned, moving forward, we definitely want to be overweight compared to the ORCI in data centers and residential assets. In terms of office, we would currently like to reduce our allocation to office, and the remaining asset classes, we'd like to selectively pick depending on the market that they're in and depending on the asset that we're looking at. One of the reasons why we want to limit our redemptions to 2.5% is because our fiduciary lies to our exiting as well as continuing investors. Allowing redemptions beyond 4.5% makes our exiting investors happy, but we are allowing them to exit at valuations that are relatively higher than we'd be exposing our continuing investors to. That's not fair to them. Our highly leveraged assets, we'd like to dispose them off, starting with our office and move towards a stabilized leverage in our fund at about 35 to 40%. With all of these strategies, with the valuations coming lower, closer to transaction prices in the market, we believe that we'll have the liquidity and a strong position to attract investment in the future and keep earning steady core plus returns for all our continuing investors. With that, I'd like to thank you guys for your time and open it up for questions.